Good day, folks. Let's talk about the recession that is potentially barreling toward us as the stock market bears ring the bell of concern with money flooding into these recession-proof dividend stocks. We're going to talk about precious metals, commodities, the Canadian versus US market. But let me preface all of this by saying,
And I always like to say, past performance doesn't guarantee future results.
that's damn right here, folks, because we don't know what's going to happen tomorrow, but what's happening today is super fascinating, and it can lead into potentially speculating on what's coming tomorrow. So if you're on a path to financial independence, to damn well one day retire early, go hit that subscribe button, join me on that journey, and smack that like before I smack you upside the head to try and stop you from making stupid decisions in your portfolio. But taking a look, not as financial advice, we're going to review the US and Canadian economic data before we look at these recession-proof dividend stocks, because the US unemployment and unemployment in general, I think, is a good resemblance of where we're at currently in the economic cycle. And as mentioned, this has been trending to the upside, which has been largely concerning. But in a period of higher interest rates for as long as we've had higher interest rates, I'm shocked the economy has remained as strong as it has been in the US, particularly because there's some concerning data in Canada. Hell, we've been through 2 recessions just within the last 5 years. And people are like, really? Well, yeah, the pandemic was a catastrophic drop in GDP. I mean, we saw a negative 28% drop. You know how crazy that is? That's like a once in a lifetime kind of event. But then we also had 2 quarters, which again, 2 consecutive quarters of negative GDP represents a recession, which we had in the interest raise cycle. But ever since then, we have been treading to the upside in a very healthy, growth rate from a GDP standpoint. And inflation has been coming down, and there's concerns if we go into negative inflation, where people have to start cutting costs to get people to spend again as the interest rate cuts come into play. I think we're playing this kind of game where people think that if they don't cut rates fast enough, we're guaranteed to be in a recession. But we've made it this far. So do keep that in mind as we flip the page into the Canadian side of the border, because Canada is in a much more stark environment. I mean, we are actually sitting at decade high unemployment levels, which when I started kind of digging into this, kind of actually became really concerning, because Canada has a very big problem ahead of it. It needs to cut interest rates. It needs to stimulate employment. It's quite clear that this data isn't as resilient as it is in the US. We've had some spattered periods and very low GDP growth in comparison to the US. We've been stalling out as an economy. It's crazy. And we can't fix it by just immigrating people like they thought. But Canada also can't cut its interest rates as quickly as we want either. Why is that? Because if we dramatically start cutting our interest rates ahead of the US, what ends up happening is Canadians are like, well, damn, I'm not getting any return on my capital from my high interest savings, my GICs, my bonds. I'm going to go put it in the US. There's more return. There's higher yields in the US still. So that's kind of the risk of why we can't, fast track what's happening in the US, even though we kind of have to. And this is why the Canadian government or the Bank of Canada actually started cutting rates earlier than the US, just not as significantly. I mean, we've been doing quarter point cuts, so we're fairly in line with the US, which we'll take a look at. But I've also noticed that we still have this AI tailwind risk. And this is something that is happening to a lot of industries. And there's a lot of talk about it on YouTube. These videos are going quite viral from small channels like Sia here. She's 2,000 viewers. Some of her videos in the last couple of weeks have been garnishing tens of thousands of views, because she says, why is it so hard to get a software engineering job? And there are multiple videos I've watched just today of people discussing this very thing about, basically engineers, software engineers are becoming fairly irrelevant to the point where one person can do the job of 3 people because of ChatGPT. The fact that we can utilize AI tools to start writing script, code, even websites are starting to get generated from just text prompts in a very quick and efficient manner. So there's a lot of concern to a lot of these technical engineers that just maybe got out of school in the last few years and are entering literally a recession for this job industry. Go listen to anybody in this industry. It is the toughest market environment for software engineers than it has been. I think the golden age was from the 2010s onward till probably 2021, 2022, and now it's been a technical nightmare. So I feel horrible for these people, because it's not going to be easy, folks. There are some industries that are getting clobbered. And when we take a look at Canadian interest rates, I mean, we are now down to about 4.25 point, whereas the US is still hovering around 5. So we're still not quite in line, which again, I think is going to continue to make the Bank of Canada tamper slow, and the US might tamper a bit faster. But we're in a space right now where we need to fight to stimulate. And I think that's what Kevin's getting at in the US. It just seems a lot more stark in Canada. So we'll see what the government ends up doing, because in the meantime, there's a lot of fear and you're starting to see it. And this is what I was mentioning, right? Like I thought this was because interest rates were going down initially, the data we're about to look at, because when interest rates start going down, I presumed money market funds, people being concerned about not getting higher rates of like guaranteed return, were flooding into the market where the yields were higher in stocks. And, we'll take a look at a few sectors, and we'll start with gold and some commodities, because gold isn't going up because interest rates are going down. There's just no way around it. I think gold's skyrocketing out of fear that we are heading into a very tough market environment, right? And if you take a look at a lot of commodities here, which is really shocking to me, lithium hasn't found a bottom in its price point yet. Lithium, this was one of the biggest booming market cycles in all commodity history. And it is still not found a bottom. And it's just crazy how much lithium is flooding the market, and the slowing demand, for electric vehicles and batteries. You figure there'd be so much demand, and the demand has slowed down. We see it in Tesla. Other car companies, maybe BYD, have been doing well, but for the most part, it's kind of incredible that there's this massive supply and demand slump going on right now, where there seems to be an oversupply, right? Look at, iron ore. These like really highly used materials are dropping significantly in price. You look at coal's crashed from the 2022 peaks. You look at steel's come down dramatically since the peaks of 2021 and continues to be trending to the downside. You look at crude oil. Even oil, even though we're at peak oil use right now, I can only presume this is because countries have been lighting up their own oil on the onslaught of the geopolitical events, but still, oil's trending down. Like, this is all great for the end consumer, but what it's not great for is the people running the businesses that are trying to be profitable off these commodities. And it shows that there might be less demand for a lot of these commodities, especially in housing, construction material, and all that stuff, which in Canada, the housing market has really come to somewhat of a standstill. Now, on the other spectrum that I do find quite concerning is the fact that speculation is still relatively strong in the market. Now, it's not as strong as it was in 2021 and 2022 when Charizards, were selling for $100,000, and Nike's, collectibles were through the roof, and NFTs were all the rage. Because right now I'm looking at speculative companies and where speculation lives currently in the market, and it is still trading at hyper premiums for the backdrop of the economy we're currently sitting in. Tesla trading at a 71 PE, which is like a 20 PE higher than Nvidia, is almost jaw-dropping to me. It is ludicrous for the most part, and it is getting to the point of extreme greed, in my opinion. If we're talking about like a fear and greed index, you look at things like Palantir, companies that are trading at just hyper multiples compared to the average in their industry. And again, I'm not saying that these companies can't do something with their business that causes a justification for this. It's just when we start to see this happen, again, it's usually a sign that we're in somewhat of a speculative market. Hell, I'm even making a bull case that Nvidia is a more recession-proof stock right now than the likelihood of Palantir or Tesla is. And that's only because Nvidia is purely drawing its revenue off companies like Meta, even Tesla, Amazon. A lot of these big mega cap Microsoft-like companies are feeding Nvidia's growth, and that's likely going to continue for the next couple years, I would suspect anyways, right? And trading at a 56 times multiple compared to Palantir Tesla makes Nvidia actually look super cheap for the growth that we're currently getting in the market environment, right? This is all very intriguing, but what we have to take a breath and step back is that there's any point in time in stock market history, there's always been a bear case for a recessionary environment, cause of concern, et cetera, et cetera. So we can only take this with a grain of salt, and I just want to take that grain of salt and show you where speculation lives in the dividend community right now, because it's in those highly suppressed, high yielding companies. And I just found it super interesting, what's going on, because typically when we're heading into these kind of, so-called recessionary environments, people will flock to things that we need to use no matter what, because people are highly unlikely, even if they're broke and struggling, they're going to cut all their costs, their extra expenditures, their MacBook Pros, and they're going to be going to buy and make sure their bills are paid for, like the lights are on, right? So like utilities, we've talked about like this utility ETF that I've been recently selling out of that's just been on an absolute tear. But my only concern with this utility ETF is it's not a very stable place to park money, because typically in highly volatile markets, this gets hit very hard with the rest of the market. I mean, during the pandemic, this thing dropped like 30 or 40%. It did take a pretty hefty haircut there of about 32%. And it hasn't seen like massive growth in the last 5 years in comparable to tech. A lot of people will look at some of the individual tech companies where we've seen a lot of the growth. You're going to take on more risk, but when you're buying some of these, you can typically get better growth in the indexes. Like Hydro One here in Canada has gone on an absolute tear with a massive run up only as of recently, which is surprising in the backdrop of a tougher Canadian market environment. Fortis only as of recently started going on an epic tear. All of this could be a sign that there are some concerns in the backdrop of the economy. Whereas what I would say is a bit more stable if you want to remove a lot of the volatility from your portfolio, especially in a recessionary environment. Healthcare is a lot lower in its volatility and comparable to some of these other sectors that are still recession proof for the most part, but the stock performance looks a lot more recession proof because even during the pandemic, because the whole market sold off where you think healthcare mattered the most, I mean, it only dropped 24% in comparable to some of the other indices, right? Which is super, super interesting. Now, what I'm fixating on the most personally, where I'm going to be watching, especially on the backdrop of the tougher Canadian market, is the BMO Equal Weight Bank ETF, or HBNK is the other one. I just always show you BMO because it has a longer track record so we can get more of an idea of the volatility, because this thing cratered during the pandemic, right? But what my interest now is these companies have done very well. Putting loan loss provisions aside, the banks have done a very good job at stabilizing. They've survived a lot of bad market environments. They're just heading into a bull run right now. And I'm very curious to see if, even though the economy slows down or stagnates, after all that loan loss provision money, all that protection money, all that money TD had to put aside for some of its lawsuits, and all this stuff starts to fizzle out and come to an end, if they can start actualizing the record revenue they've been making over this interest rate cycle, and to see if we actually get a boost, even if the market's tougher. I'm speculating these Canadian banks can do exceptionally well, even still. Which I'm very curious to see. So I'm going to be watching these like a hawk, because a lot of people have money in here and we just started getting some good performance. So it'll be neat to see if this kind of continues its rally. A lot of people are looking at other sectors too, like the tobacco sector, which historically is a place to run to in bad economic environments, because as the economy gets bad, as people get laid off, people tend to turn to drugs and alcohol, right? Though it's not the best thing in the world to do. It's just something people tend to opt to do from a psychological standpoint. And it looks like we're seeing a big run up in British American. Philip Morris hit an all-time high as of recently, which is just, congrats to people that, stayed with this for dividend income. But at the end of the day, as much as you can run into these sectors for stability, these are what I would call old people retirement-like sectors. And if you're watching this video and you're in your retirement, I'm probably speaking more to you about some of these industries, because they're going to affect you more. As in retirement, you want stability, you want more reliable income. You're going to be chasing sectors like this, and you're probably going to be weighting them a little bit higher within your portfolio. However, I do want to preface that if you're my age or younger, the real resilience, as much as there's volatility behind it, is going to be in big mega tech companies. As mentioned at the beginning of this video, AI is largely disrupting a huge amount of industry right now, and people don't really want to discuss it as much, but outside of all these interest rate sensitive sectors like utilities, that as interest rates come down, they should also bolster on the back of that. You have to keep in mind, these companies like Google, like Apple and Microsoft, these balance sheets are almost insane. And they tend to be the most volatile companies, which I find interesting because they have the most stable backing of most industry because of how resilient their balance sheets are. I mean, look at Meta. Meta went through one of the absolute most absurd drops, 70%. 76% from peak to bottom just within a year time frame. And if you bought those very bottoms, you saw a 520% excelled return back to all-time highs. Now, if you could kind of spot these advantages, you can make a lot of money, and it's hard to stomach this kind of volatility, which is why if you're younger, I would focus more toward cost averaging into things like the S&P 500, so you're upper weighting these absolute resilient companies. Because Google, for example, I mean, this company, Google, look at this. They have $110 billion in cash as of 2023, a lot more than that. I think, because we've talked about the recent quarterly earnings that are just as incredible. The company is expanding its margins. It could go into a rougher market environment where ad spending freezes up a bit, but this company can survive any rough market environment. They just have more cash, more assets than almost any company under the planet. I mean, you look at $402 billion in assets against $119 billion in liabilities. They've almost got $300 billion in assets minus their liabilities. This company could freeze and go to a standstill tomorrow, and they could continue operating for what, a decade plus, probably for a long time if they just cut up a lot of their expenses. I mean, these numbers are insane, right? So I want you to keep that in mind always, right? Like, you want to go where money's most efficient and where it's going to give you the longest rate of return, which is why I'm advocating so much that you continue to look at tech and continue to cost average into where the future is going. As much as me, Kevin, as much as there's going to be a lot of fear mongering in the market, that is only going to open up a buying opportunity for you, and you need to buy the dips. That's all you really need to do. And, there's a lot of people out there that are saying, oh, this time it's going to be different. It's not just buy the dips and see a return. Remember, you have decades ahead of you. We are not talking about short-term trading mindsets. Even if the market goes into a correction cycle, get a diversified holdings like I do in bank ETFs and Canadian stocks, and just use the dividends to constantly reinvest, because there's no guarantee that things are going to be easy tomorrow. But from what I can tell, we are not in a recession yet. There's no guarantee of a recession tomorrow. It's going to be a case study for all of us to watch the interest rate cut cycle unfold and what it does to interest rate sensitive stocks and the broader market as a whole. But I'll be right here with you watching it and investing along the way. So, like I said, I'd love to know what you think in that comment section below.